All right, let's talk about the golden rules of trading. We all know them, right? We memorize them, we print them out, we stick them to our monitors, and yet somehow we constantly break them. Today, we're dissecting one of the greatest paradoxes in finance to answer a literal multi-million-dollar question. When is trading against the trend actually the right move? So in this explainer, we're going to cover a few key things. The trend is your friend concept, what swimming upstream actually looks like, where the crowd gets it totally wrong, 4 very specific signs of a reversal, and how to beat your own brain's psychological traps. Let's get right into it. Part 1. Is the trend really your friend? The trend is your friend. Look, whether you just funded your first brokerage account this morning, or you've been in the trenches for 20 years, you've heard this. It's literally the very first mantra drilled into our heads. Okay, let's dive into this. Because if we all know this rule, why on earth do we constantly do the exact opposite? Seriously, traders are notoriously guilty of trying to short a raging parabolic bull market or stepping in to catch a falling knife right in the middle of a crash. We all want to call that exact perfect top or bottom, and then we act completely shocked when our accounts just vaporize. That massive disconnect between trading theory and actual reality, that's the trap we're unpacking today. All right, part 2, swimming upstream. To really wrap our heads around this, we've got to stop looking at the market as just squiggly red and green lines on a screen. Ultimately, a trend is just the raw direction of money flow. That's it. In an uptrend, buyers are aggressive. Capital is just flooding into the system, and they'll happily pay higher prices. In a downtrend, sellers take the wheel. Grasping this literal, physical flow of capital is absolutely crucial if you want to survive out there. Think of it like a rushing river. Trading with the trend is like swimming with the current. Now, sure, you still need some basic skills so you don't drown, but the water is doing the heavy lifting for you. Counter-trend trading, well, that's like deciding to swim straight up a waterfall. I mean, could you do it? Maybe, if you're some kind of Olympic athlete, but the sheer effort required is massive. The risk is astronomical, and literally one tiny slip means you're getting swept away. Moving on to part 3, mistakes of the crowd. And here is where we find the absolute costliest illusion in retail trading. People stare at a chart and tell themselves, wow, price has gone up way too much. It simply has to drop now. Or it's dropped so incredibly low, it's guaranteed to bounce. But here is the brutal truth. The market absolutely does not care how far or how fast a price has moved. 0. It only cares if money is still flowing. Accounts get blown up every single day because people try to apply rational logic to an entirely irrational stampede. Which brings us to part 4. 4 objective reversal signs. So, is it ever okay to trade against the trend? Actually, yes, but only, and I mean only, if you completely replace guessing with a rigid objective system. We like to use a framework built on 4 specific pillars: exhaustion, liquidity zones, extreme consensus, and market structure changes. Let's break these down one by one. First up is exhaustion. Look, no trend lives forever, right? After a massive euphoric run-up or a terrifying freefall, the market eventually starts gasping for air. You'll start to see momentum slowing down, trading volume dropping off a cliff, and price reactions that just feel kind of sluggish and abnormal. When you spot these early symptoms, that's your cue that a major correction might be brewing. Pillar 2 is liquidity, and this brilliantly illustrates how markets actually function. Markets are essentially giant machines, and they run on fuel. So where is that fuel stored? It's sitting exactly where the crowd places all their stop losses. We're talking old highs, old lows, and those big, juicy, round psychological numbers. It is definitely no coincidence that the most aggressive, violent reversals happen right at the exact levels everybody is staring at. The big money is literally just hunting for that liquidity. Then we have Pillar 3, extreme consensus. Now this sounds kind of backwards at first, doesn't it? But think about it. When literally 100% of financial news articles and online forums are screaming that a market is going to the moon, the actual risk is at its absolute peak. Because if everyone has already bought in, who is left to push the price any higher? Nobody. When the boat gets way too crowded on one side, it flips. Finally, we have the ultimate decider, the most crucial factor: market structure. You need to memorize this right now. A raging bull market doesn't just suddenly die because of one random red candle on a chart. A trend only officially ends when the underlying fundamental structure breaks. And honestly, if you actually wait for that structure to shift before you enter a trade,
you aren't even really counter-trend trading anymore. You're just super early to the brand new trend.
All right, part 5, overcoming psychological traps.
Let's face the hardest truth in trading. The hardest part actually isn't finding the trend. I mean, let's be real. A 5-year-old could probably point at a screen and tell you if a line is generally going up or down. No, the hardest part is putting your own ego aside and just accepting it. Our brains are hardwired to crave that massive dopamine hit of feeling special and predicting the absolute exact top. But real, sustainable, long-term profit, that comes from the incredibly boring discipline of just following the flow.
So the crucial point here is that we really need to redefine that classic mantra. The trend is your friend does not mean you just blindly buy right at the absolute top of a massive run. What it actually is a strict, blaring warning. Do not fight the flow of money without a crystal clear, completely objective, structural reason to do so. As the old saying goes, the market can remain irrational a whole lot longer than you can remain solvent. To wrap up this explainer, I want you to ask yourself this one simple question right before you place your very next trade. Is your urge to bet against the market right now genuinely based on an objective, calculated break in market structure? Or is it really just your ego, your impatience, and this deep-seated desire to outsmart the rest of the crowd? Answer that honestly, and you just might save your entire account. Thanks for joining this explainer, and stay disciplined out there.